All right, good morning, everybody. TGIM, and welcome to week 44. It is Monday, the 30th of October, end of the month, and going into a new one. And hope everyone had a fantastic weekend up ahead. As is always the case, we are joined by the very talented James Kim, who will be walking us through some bodacious charts. And everything obviously discussed or viewed here is solely views or opinions. They're not trading, no investment kind of recommendations. So there's been really a lot on last week, and there's a lot on this week. Impossible to cover everything and still kind of keep it concise. So I'll try and touch on at least the things that stood out to me. On the political front, the noise continues, whether you're talking about out here in the Asia Pacific, with not just from New Zealand, but most recently from Australia, seeing the government majority wiped out following the whole dual citizenship ruling by the High Court. That remains to play out basically kind of into year end. We've had increased noise in Catalonia, and from my perspective, I think we're getting more towards the end game. Some people may think that's too early, but at least from the views of the power now also being shifting back to Madrid and then elections being called for, I think we're closer towards the end of the tunnel than from the beginning of the tunnel. We are, of course, still waiting. The Fed chair continues to be very, very much top of mind. Key thing, obviously, from noticing last week was obviously the end of the National Congress Party. Xi cementing basically his role as the most powerful leader, getting his name written down in the Constitution, and also re-emphasizing SOEs very much kind of here to stay. And interestingly enough, also not really putting an apprentice forth, so implying that potentially he will be serving more than the next kind of 5 years. Economic data continued to beat. This was great to see, at least from the view I have, which has been inflationary, which has been risk to the upside. We had U.S. GDP, which smashed it at 3% when 2.6 was expected. This is also taken into account the two hurricane effects that we had, which I thought was very, very strong showing of an economy basically growing and accelerating above trend. We also had personal consumption beat at 2.4 versus 2.1. That was expected. And the other, obviously, key focus last week was really all about ECB. Got a much more dovish and cautious Draghi. We'll expand on that a little bit more. I think on the market price action side of things, what's interesting is, even though we were up for the week on US 10s, we did pull back to 240 because the highs we'd seen were kind of around 248, right? And of course, divergence in the European side. Big rally in bonds, given Draghi disappointing what the market was expecting. And lastly, and very, very importantly, because there was a lot of key levels from last week, I'm sure JK will be touching on this, was the DXY getting over 94, which we've been flagging has been a key kind of level to get back and over. On the COT report, we're basically seeing the same theme that we saw last week. We've now eclipsed the move last week and now have had the biggest US dollar reduction year to date. We're basically down to about 10 billion from a little bit over 20 billion just a few weeks back. So interesting kind of move back there. Funnily enough, given that this data came out on Tuesday, you're actually not seeing much change on euro. I expect that to change significantly when it's updated for next week. You have seen a reversal of sterling longs to the market now being back a small kind of net short. And you've seen the first sizable move in the Swissy that I can remember in quite a few months, if not quarters, as the market starts to kind of go short and as we kind of flirt with getting to above parity and then kind of potentially exploding upwards from that perspective. And based on kind of this Tuesday, there was not that much kind of delta in regards to loonie positioning and Aussie positioning. On the commodity report, a little bit less exciting. Overall positioning very much unchanged, at least on an aggregate kind of level. I think interesting to see still, despite how well the dollar has rallied, gold and silver, very little kind of reductions in regards to kind of overall kind of positioning. They have also, maintained quite well bid, to be very honest with you. Surprised at that. And I think the other interesting thing that Ole was flagging here, and this is actually just quoting him directly from the COT report, is on cocoa, where it goes, and despite the kind of huge rally that we've seen, people are kind of still net short and thinking that potentially could change. So it could be some homework work for people looking kind of the softs and agri stuff. Going on to kind of week ahead, as I said, there's really, really a lot on. We'll touch on some of what we feel is kind of the highlights. Also, just from a technicality kind of measure, do note that we do have daylight savings time shift in Europe, which kind of came through over the weekend. So Key event from at least a central bank decision this week should be the BOE on Thursday. Markets expecting about 88% implied rate hike. I think they will hike, more from the perspective of they kind of have to follow through. I think it's more that than really anything. Obviously, we had inflation coming in at 3% above their 2% threshold, and we also had strong GDP, but we've also had other mixed signals. So I just believe, just given the history of them flip-flopping a little bit, that they definitely will move on Thursday, and then it'll be about language, whether it's construed as one and done or risk to kind of the upside. Wednesday, with at least Thursday morning Asia time, will of course be FOMC, which will be nothing to see here, very much kind of a yawn. I think it's going to be a copy paste statement. December is still very much on, even though they don't need to emphasize it. Market currently has an 85.3% implied hike for December. I think, again, been banging the drums for this, so we'll continue to do so. 4 dots are not enough given the level of growth, not just in the US, but globally, how well spread out it is. Tightest labor markets we've seen in decades. US ISM at 12, 13-year highs. And again, all this pre-fiscal stimulus, i.e. whether it's tax plans, deregulations, and I'm pretty sure something will be passed through before midterms next year. So I think, barring any knee-jerk reaction on the Fed chair, it seems to be down to Powell in the lead and Taylor a close number 2. From my perspective, I just think it's too much of a coincidence that we seem to have a perceived dove and a perceived hawk so close to get in the role. I think it just smells a little bit too baked for drama, aka their apprentice. But of course, we still have to wait to see what goes through. But I think it's kind of inconsequential, barring the initial kind of knee-jerk reaction, right? So we also have quite a few Fed speakers this week, which will obviously be posting up after the FOMC. We also have Kuroda speaking tomorrow. Canada will have Paulos and Wilkins later on Wednesday, and there's also a holiday in France and Italy, and we'll also have Norsebank Olsen's speaking through. Key data, obviously, is final PMIs, given the end of the month, start of the month, personal spending and income from the U.S., ADP, of course, non-farm on Friday, which, first big 300 figure in quite a few months is expected there. And then, of course, out here we'll also have China manufacturing and services, both official as well as the CAIX, and also being expected. GDP out of the Eurozone, flash CPI, and the not. So you can see there's a lot of stuff coming through, and not to be forgotten also jobs data out of Kiwi, which is quite key. BOC, I think last week was a lot more dovish than expected. Whether that's true or not, we saw basically, we've seen a massive reversal of dollar CAD, especially kind of post ECB, as that just strengthened the US kind of dollar. I don't think what Draghi is doing is should be too much actually of a surprise. It's kind of the Yellen US dollar kind of ninja script in essence. He came out a lot more cautious and dovish than the market was expecting, going even so far as to say this is not tapering. If you think about it, his caution makes absolute sense. Inflation is still fragile in the Eurozone. A hawkish Draghi would have been a very kind of high euro, which would curb inflation in the Eurozone. Now, you could obviously argue, why didn't he mention this kind of before? That I really have no kind of answer to be very honest, because obviously this is also something that could have been communicated in the prior meeting, or when euro dollar was up in the kind of 122 handles, or wherever we kind of got to. Just quickly on positioning, I'm sure JK will expand on this on charts and levels, but this is just my kind of quick take. DXY closing in 94.80 is really significant, above that key resistant level of 94. To me, I feel this opens up to 97. I still don't feel that we've had a USD squeeze yet, despite kind of the big move down in obviously the COT report. But to me, it still seems to be much more of a grind up, especially against kind of G10. Granted, we've seen some FX exceptions, but I would argue that a lot of these have been linked to specific things, like in Turkey, it's been with the politics, New Zealand, Australia, ditto the same, Mexico, it's NAFTA. So I still think that there's room for seeing quite a bit of a tactical squeeze in the US dollar before end of November. I think things that could potentially unravel that kind of view and that kind of stance on tactical is obviously a Powell nomination, where the market seems to be taking him as quite dovish. I don't think that's actually correct. I think that reversal in US 10s, to 240 is wrong. I think it just basically gives you an opportunity to, put the structural kind of shorts back on. And of course, an equity kind of meltdown as well would something that I think would probably make this Fed kind of think twice. But again, we need a minus 10% kind of move, which is just something we've not seen. I still think, I'd use any kind of risk off or should I say dovish moves in the market, given the Fed chair nomination, to potentially kind of go back in, put tactical dollar longs, more importantly, put tactical and structural duration kind of shorts, and look for what kind of different openings up there, so to speak. On the books, there's a small update on the tactical book. Stopped out of the high conviction SIL position, where in hindsight the timing was just completely dead wrong. Still like this structurally. We still have it in the structural book. Obviously, we're obviously at risk of also that kind of being stopped out. The euro dollar short that we've had that was underwater until this week has kind of been dampening the mark to market. I still think we will break down over the next 1 to 2 weeks past the 115, potentially 114, 114 and a half. The lows last week were 115.75, and we're hanging here Asia morning session at about kind of 116. On a strategic book, again, nothing unchanged there. And with that, let me please pass it over to James Kim for walk through the charts.
Thank you, Kay. It was a strong and decisive week for the US dollar in the past week, as it logged a solid weekly gain, as well as claiming its first 23.6% retracement level, with next upside target now sitting at the 96 handle, or the 38.2% retracement between the 2017 high to the low. The market also saw two settlements above the neckline of the inverse head and shoulder formation, which confirms a valid and a proper break. Now, we've been flagging this formation for weeks now, and last week was a defining week that saw US dollar bulls take control and to drive the US dollar higher. Again, the end target in this reversal pattern sees the US dollar going potentially as high as 96.80, or where the 200 DMA currently sits, and this target level was derived by applying the distance between the head to the shoulder, and then applying that to the shoulder break. This week's resistance starts at 95.42 on a higher move, starting at 95.42 up to the 96 handle. And what would be a desirable move would be for the US dollar to retrace lower, to retest that neckline as that it broke, and this would offer a strong buying opportunity at the neckline. So we look to pay anywhere between the 94 handle to 94.10 should we see this opportunity. The inverse symmetry holds true for the euro, as it too last week broke its perfect neckline, with it experiencing a slight recovery after achieving its very first target level on Friday at 115.73. So the reaction that we saw at the 23.6% head to shoulder extension target validates this neckline here. So the end target comfortably sits at 112.50, and we now remain short for 3 straight weeks now. For those traders that are currently still neutral, as they've been waiting for this confirmation, well, that confirmation was served last week. So one can look at new shorts being initiated here at market, and to also have offers placed at the neckline or just below the neckline at 116.70. Stops on all outstanding short positions will be placed at 117.50. Now, a clearance of the previous week's low would open next target at 115.10 in the week ahead. The 50% target extension target at 114.59. Should we be able to see that this week? Is expected to be very strong. So for those that have been heavily short, may want to look at unwinding some positions here. The bullish price actions continued for the dollar Swissy, but Friday's behavior signals indecisiveness. So before the pair reaches our profit target here at 100.80, we may have a chance to add to our bullish exposures on a retracement this week. The dollar Swissy went as high as 37 points above parity on Friday. However, failed to close above parity, instead finishing the session with a what we call like a bit of a spinning top formation. We mark support starting at 99.10, which is around these levels here, down to 98.60. However, prefer to see the dollar Swissie hold above the 99 handle. So traders can look to add to long positions at 99.10. And summarizing our analysis from last week, we have a double bottom here, applying the rules of a double bottom range. The 200% repeating range comes in at $1.80, and coincidentally, this happens to be the noisy 2017 April and May swing high. The Aussie dollar smashed through every support, every buy level we looked at last week, and also damaged its 200 daily moving average. Our Friday's bounce was caught at the 50% retracement level between the 2016 December low to the 2017 September high. First resistance and challenge would be posed at the 200 DMA. One could look to potentially fade this 200 DMA rally with a tight stop. Further gains above here could see the Aussie struggle at 77.30 or the early October swing low here. Now, below last week's low lies a significant uptrend from December last year, which connects the May and June lows, and we expect losses to hold at this uptrend should last week's low fails to hold. We saw a clear break over the US 10 years to levels last seen in the first quarter of this year. Any further gains in bond prices are expected to see resistance at this original May, July, early October support trend line. The dollar yen attempted to push to new highs, however failed on Friday as prices reversed off the highs seen in May and July. So for now, we have potentially a temporary triple top formation with prices sitting on the October sharp uptrend here. Levels to watch for support starts at 113.07 and below that sits 112.65. The test this week is obvious, and that is to claim this May-July resistance level. Otherwise, if prices carry on next week below here, the triple top curse could start to put pressure on prices next week. The Nikkei successfully takes out the 2008-2015 upper resistance trend line. From here, we have no levels to mark as resistance. The same goes for the S&P as it continues to rise. Although the heavily overbought backdrop as measured by the RSI is the only signal for caution, our ASX is able to enjoy broad gains, although we are underperforming our global peers. Our target to the top side remains at 59.50. This is derived by applying the 5-month consolidation range to the breakout we saw earlier this month. This WTI crude prices fast approaches levels seen earlier this year as it punched through the final retracement level last week. Our price action looks extremely bullish. We target the 55 handle and the support is offered at 52. The long-term weekly trend line sees that crude was able to break free from the 2015, 2016 and the temporary 2017 downtrend as well. Lastly, on gold, prices are just floating here at the original January, March, May trend line with a brief break last week, finding support above the 200 DMA and at the early October swing low. This week's close is extremely important with the need to settle above the 200 DMA for those gold bulls. That being said, the 200 daily moving average is the weekly support or the strong weekly support for gold in the week ahead. That's it from the charts. Back over to Kay.
Thanks, JK. So kind of in summary, very, very key week up ahead. Lots of economic data watching. You know, the takeaways from last week is a very, very strong and decisive week on the US dollar. We have econ data accelerating with the US potentially growing above trend, with also not just flash PMIs being strong last week, but also GDP smashing it at 3% versus 2.6 that was expected. For this week, the Fed is nothing to see here. It's just going to be a statement. even though they may flag that potentially they are moving in deck. It's really all about the BOE on Thursday, and that's going to be language as we expect, along with the market, that they will hike. The Fed share is irrelevant, and apart from the initial kind of knee-jerk reaction, still feel very much risk is skewed to higher rates, given not just commodities breaking to new levels, but just the inflation pressures are going to coming through. It's worth looking into the political noise to see if it's a little bit overdone, both in Australia, New Zealand, and Spain, and to see if there's any kind of trades there. And the key econ data to watch out for this week is, of course, PCE today from the U.S. and non-farm Friday. And, of course, final PMIs pretty much across the board from China, Europe, to also the U.S. On the technicals and charts, we're long DXY. 97 is what we're targeting. We continue to remain short the euro dollar. For those who don't have exposure, JK Advocates potentially coming in at these kind of 116.10 levels, targeting kind of 115.10, 114.60 with a stop at about 117.50. Dollar Swissy needs to close above parity for the next kind of big leg up. Dollar yen struggling to break that key 114. We've had basically three tops there. Support should be 113.07 and 112.65. An interesting divergence with the Nikkei, which basically is in absolute kind of liftoff. And oil continues to like very much, very bullish. 55 is really kind of the next level. And with that, let's wish everyone a fantastic week up ahead, and have a great one.